Hello traders, Gary Wagner here, approximately 11:15 in Honolulu, 5:15 in New York. It is Friday, finally, the 5th day of October 2012, and this is the daily report for gold and silver. Following the release this morning of the jobs report from last month, came in at about expectation, but at the same time, the unemployment rate did drop to 7.8. We saw this put pressures on the metals markets, although trading well off the lows. They are going to close strongly or substantially lower today. Our current print, as you can see, is 1780.36. Kitco has the bid at 1781 and 1782 as the ask, putting it off about $9.30 on the day. Silver, as you can see, also closed lower. We'll talk about this impenetrable, at least up till now, $35 resistance level later in the show, but it did close off about 45 cents on the day. As you can see, 34.55 current print. Low 34.19, high 35.18. We saw pretty quiet markets throughout the evening session last night as traders and investors were awaiting the release of the jobs report this morning. When that report came out, initially it softened the market about $5 to $6, drifted a little bit lower, came up and made a low somewhere around, I believe, 71. We see our close here. We're looking, of course, continuous contract of the COMEX at 1783. So we saw it come off of the lows. You'll see that better when we convert this to a straight candlestick. This is Henkin. It is an average chart, 420 minutes in length. And the reason for really starting with the shorter term, we'll move to daily and then weekly as we look at the week in review in terms of gold itself. But you can see that we did in fact make a higher high. You can see that right in here. I'll try to draw that as straight as possible. And when I say a higher high, I'm talking about these recent stabs that we had at new highs. We talked about the fact that we call them a scouting party, unable to take that out. But you can see that it did drift higher, and on a closing basis, at least for a little while, we had some sustained closes right at around the 1790 area. That, of course, was to be fairly short-lived because, as you can see, market came down following the release of that report this morning. Now, I have simply converted our 420-minute Henkin into a straight candlestick. And the reason for doing that, it gives us a true view or look, of course, at the open, low, high, and close, unlike the Henkin candle, which uses the midpoint, the prior midpoint, to fix as an open, changes a little bit. And what you can see is this. Jobs report comes in, market sells off pretty hard. Here's the lows that we hit in the December. It looks like it's going to be around 1773. Market did recoup off of those lows. You can see that during the last session, the last half of trading, you can see that the market actually closed higher when you compare it to the open of this session itself, 420 minutes. Now, once we convert the shorter term trading cycle to a daily chart, straight candlestick format again, we get really a different view, but I think this is a really valid view to take a look at. And then, of course, I want to take a look at the big picture and what I think we're in store for over the next week and the next couple of months. But when we look at it in this way, the first thing that's very, very apparent, and I'm going to try to line this up the best I can, what I'm trying to do is really line it up really to this top, because this is that highest of the closes that we get on a daily basis. You can see here we've got some highs, but of course on a closing basis we don't really take these particular points out. Here it closes above that key area, and what I find heartening and what I find rather good news for the bulls is the fact that even though on today's trading activity we get a red candle, no doubt about it, we actually have what is known in Japanese candlestick patterns as a harami. To the Western trader, it's simply called an inside trading day. It's when the open and close of this trading range can be defined within the prior sessions trading range. You can see that here. But what I'm finding that's pretty noteworthy right here is the fact that it managed, even though it closed lower, it managed to close at or slightly above this critical area. And what we have talked about really all week is for this to be a valid move to the upside, and we're going to get up days and down days, but for it to be valid, what we need to see is we need to see former resistance become support. What would that look like? Well, typically it would look a lot stronger than this because you would have up or green candles coming off of this, and they would be going to new higher highs and higher highs with higher lows. However, we are seeing the fact that it was able to, at least today, hold this level of support, closed right at it. So it could go, of course, either way come the beginning of the week next week, but it didn't really trade far into it. And even when it did, as you can see, most importantly, it closed right at that level. The second thing is we're looking at a daily, it's a short-term moving average, 14 cycles right in here. And you can see that we're also still trading above a 14-day moving average. Very, very short term, but nonetheless gives us an indication of what effect, long-term effect, the sell-off today had within the market. And I'm going to say up till now, it's fairly negligible. It's not that much at all. Let's take a look out into the future. Now, we're going to look at 2 weekly charts. This, of course, being the first of them. Really no work on it, meaning Elliott wave, Fibonacci, any kind of pattern recognition. We just want to kind of take a straight look at it. On a weekly basis, first of all, gold did close higher. It opens and closes, so you do have a green candle. Second thing is we've been talking about this for the last couple of weeks, and that's the fact that preceding that, these last 2 weeks have been really characterized by very, very tremendous ranges. In this case, a higher high. But at the same time, the main noteworthy characteristic is the open and close are almost identical. They're doji candles, meaning they're either consolidation candles or the reversal candles. In a typical market, dojis, especially double dojis, would be a very, very strong indication, almost an 80 or 90% probability that we were going to see some sort of a reversal. However, in the gold market, that hasn't been the case, because what we tend to get is both when the market's moving up or down, we get a series of moves to the upside, followed by a series or a time with consolidation, then followed by another burst to the upside. And so are we seeing that, or are we seeing a reversal? You know, the information is not complete enough for me to give you a definitive. My sense is that it is, in any way that it can, trying to form the base. The question is whether or not it will be able to do so. Now, irregardless of whether or not the market corrects here, we see wave 2 come into play, a corrective wave, before resuming on the upward path. Let's take a look at the big picture, because that's what we really need to focus on. I am still firmly of the belief that we're absolutely out of the correction. We defined that as it broke above this area here, 1636. We really defined it when it broke above this compression triangle. And then that was followed by aggressive weeks to the upside as we saw the market move literally almost a couple $100 when you consider the move itself has been from about, call it down here, just in above 1500, 1530 to 1560, and it has moved to about 1780. It's a tremendous move to the upside. Of course, we were trading sideways right in here, but once we broke out above this resistance that we identified, we had tremendous rallies over the last month, and that's been followed by these last 3 weeks, which have been a consolidation area. To that end, we want to take a look at forecasting the market, and we've been talking about different models. This is one model that I put up on Kitco this morning in our email newsletter. I'll put a link in so you can read the article in its entirety. And of course, these particular waves, 1 through 5, I'm not really looking at size or what type of correction you're going to have and really where the market's going to stall and correct, because without having wave 1 as our benchmark, the only plausible scenarios to work with are simply by comparing this particular wave potential with the waves that preceded it, meaning wave 1, major, and major wave 3. This is an extension of major wave 3, and we'll talk about this right now. Here's the key. Whether or not, even if this market begins to correct, and I've talked about the fact that we've had really, really strong resistance at around the 1790 area. We actually took it out on a closing basis, but on the week it closed under it. And we can't say that it was able to really take that price point out with a fury. Of course, once it takes that price point out, it's got 1800. And I don't know if this is the consolidation before the rise to 1800 or if we'd have another session where it attempts, goes over 1800 and falls back. I'm not sure about that, but what I can tell you is this: regardless of whether it corrects here or it corrects a little bit higher, my belief right now is that we will probably see a range on the fifth wave, this major fifth wave, which propels us anywhere between, call it 2150 and about 2400 per ounce. It is simply based upon the fact that 100% move, if wave 5 equals wave 3, 2341. If it's 61% of that, you've got 2028, 76% of it, 2147. I believe that it should go within this range right in here. In terms of where these particular subwaves are going to come in, once we have calculated and gained technical confirmation that we're in corrective wave 2, we will then use wave 1 as our benchmark, and we have specific formulas to analyze what wave 3 should do, what wave 4 should do, what wave 2 should do, and of course our concluding wave 5. Silver. Now silver's a little bit of a different story here, because you can see we're looking at a 420 because it really illustrates a point that I'm trying to make. We have talked about over the last 2 to 3 weeks the fact that this $35 point, this 35 per ounce, has been really attempted on numerous occasions to take it out, to close above it, and in each case was pretty much unsuccessful. We came really close the other day. We saw it trading up above it. It seemed to be comfortable around $35.50 an ounce. My sentiment was, if we could see it on a closing basis for a couple of days, I was actually looking to add to the positions here and add to the positions in gold. If you read the commentary from yesterday, it hasn't been able to do that. And that's why I tend to like to add positions on breakouts rather than on dips, because if it can hold a certain level, in other words, at the point in which $35 becomes support, what we're going to be looking to do is to add to the positions that we began at $29. At $35, we've got a $6 trade and we'll look to add. But until then, I simply want to hold with the positions that we currently have. This has been Gary Wagner, wishing you as always good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.